A changing, less affordable housing market doesn't mean that you can't invest in real estate, but it does mean that you have to change your approach to investing. And the most common thing that I hear is that you have to change your underwriting strategy in this type of economic climate. Underwriting is just another term for deal analysis or running the numbers on a deal. So the question becomes, how do you underwrite a deal properly given the challenges and unique elements of the current economic climate? So there are essentially two different parts of underwriting or deal analysis. The first is the math component. You need to be able to accurately calculate things like return on investment, cash on cash return, return on equity, those types of things. But as I'm going to show you over the course of this video, that stuff's actually pretty easy because we have computers, we have software, you don't need to be doing this stuff by hand, and if you have the right tools, you're going to be able to calculate that stuff no problem. The second part of deal analysis is your assumptions. What numbers are you putting into the calculator? Because if you put in great assumptions, you're going to get strong, reliable, accurate results out of the tools that you're using. If you put in bad assumptions like the wrong estimates or appreciation assumptions, then your analysis is going to be wrong, no matter how good your calculator is. But don't worry, that is not going to be you, because today we're going to discuss how to make good assumptions and put them into a good calculator so you can get accurate deal analyses and pick great deals even right now in 2024. And if you like the look of the calculator and some of the other tools I'm going to show you, like the rent estimator, those are part of BiggerPockets Pro. And just for watching this video, we're going to give you 20% off BiggerPockets Pro. Just use the code DAVE24, DAVE24, when you go to biggerpockets.com/pro, or hit the link in the description below. So for today's demo, I picked a deal, and we're actually just going to walk through this together, and I'll share with you how I come up with the assumptions that I put into my deal analyses. I picked a deal just it's easier to walk through on in Waxahachie, Texas. This is a small city on the outskirts of Dallas. It's a little bit south. And I picked this one, because it's an affordable city. The median home price is below what we see across most of the country, and it's growing like crazy. There's this population boom going on in this city, even more than the rest of Texas and more than Dallas, which makes me think it could be a good market for rentals. So I'm just going to pull this up, and here's the deal we're going to look at. It's $265,000, 4-bed, 2.5-bath. It's a nice size house, 2,750 square feet. But the selling agent says that this is a fix and flip property and that it's going to need a cosmetic rehab. But one of the things that I like about it is that they said that the roof is just 3 years old. There is a good foundation, but we're going to need to do some servicing on the HVAC and a cosmetic rehab. So with that, let's jump over to our rental property calculator and run the analysis on this deal. If you want to follow along, you can use the BiggerPockets calculators a few times for free to try it. So just go to biggerpockets.com, go to this tools thing in the navigation bar, hit rental property. It's going to bring you here, hit start a new report, and we're going to get started. So there are 5 steps in running the numbers on a deal. You can see them on the left here. They are property info. It's just basic information about the deal. Purchase conditions, loan details, rental income, and expenses. Let's hit these one by one. So first things first, I'm just going to copy and paste the address here. And then when I do, the BiggerPockets calculator is going to pull in a bunch of information about it, like the zip code, taxes. I'll show you that in a little bit. So that part's easy. And then I'm just going to add a photo so I can remember what deal we're talking about. If I were really looking in this area of Texas, I'd probably be looking at 10, 20, 30 deals before picking one. So just adding photos helps you remember them. So that was step 1. That part's obviously the easiest. You're just copy and pasting, that kind of thing. Next, we're going to move on to purchase condition. So this is where we put in what we think we can get the property for. And for now, let's just assume that we're going to pay full asking price, which is $265,000. But we're going to come back to this in a few minutes, because I'm going to share with you some data that will help you decide how much you should be offering on properties like this. But for now, we're just going to assume that we pay full asking price, $265,000. Now, closing costs are going to be about $5,000. And if you guys ever get hung up on any of the inputs here, you could just hit these little help buttons over here and they'll tell you information like, if you're unsure of closing costs, 1.5% of the purchase price, good number to begin with. Now, one of the cool things about this tool is it does allow us to account for the rehab of this property. So we're going to need to put two things in here. First is the after repair value, which basically means what do we think this property can get to in terms of value after we make the renovations. And that's super important because we only want to put in money and make renovations if it's going to increase the value of that property, right? And so the way to do this, and this is one of the key things about making good assumptions during your deal analysis, is looking at comps. Now, comps just stands for comparables. And basically what you need to do is look at properties that have sold in the area recently as possible, and in as close of an area as possible, ideally on the same block within half a mile and in the last 3 months, and see what those properties are selling for. And then look at the condition of those properties, compare them to yours, and see if you think that your property is going to sell for more or less. I could show you some digital ways to do this. Like I just went on Redfin and pulled some comps for this property, and you can see here, this is a good comp. This first one here, it sold in March of 2024, so very recently. It's a smaller property, but it's a lot newer. But this sold for $370,000. It's 4-bed, 2-bath, so it's a pretty similar property. Ours is bigger, but older. Then the next one, this is an older comp, so it sold almost a year ago. It's 4-bed, 3-bath. Again, it's smaller and similar age though, and this sold for $365,000. So this is one good way of finding comps. The other great way of finding comps is talking to your agent, because they're going to know the market really, really well. And so if you have a good investor-friendly agent, like I hope you do, you should just ask them about comps. So I did a little bit of comping, and I feel pretty comfortable given those two comps that we would get in the 360s range. So I'm just going to be conservative and put $360,000. I do think it might actually be a little bit higher, but in today's market, given everything that's going on and some of the uncertainty, I like to err on the side of caution. And, I think this could be 375, it could be 380, but I'm going to be 360 here to be extra conservative. Now, the big question is repair costs. And to get an accurate quote, you're going to have to talk to a contractor, but you can get good at this just with your experience. And so I know that HVAC is probably going to cost us about $5,000. A full cosmetic rehab on a property that's 2,700 square feet is going to be fairly expensive. So I'm going to assume that we're putting $50,000 into this deal. That's a lot. And again, I'm trying to pad that. I do in my mind think this could maybe be 35, it could be 40, but I'm going to pad it again to be conservative during these uncertain times. The last thing we do here in this purchase price is hit property value growth. And this is basically our assumptions for appreciation. And again, this is key to deal analysis, is making the right assumptions. Now, if you want to be conservative and just be as careful as possible, which is fine, it depends on your risk tolerance, the 2% is good annual property value growth. Normally over the long-term average, property values grow 2 to 3%. That's like the 50-year long-term average. Of course, over the last couple of years, that really accelerated, but that's not good data in my opinion. There were so many anomalies, weird things going on in the economy that I don't think you can trust depreciation rates from the last few years projecting forward. Now, Texas is a fast-growing market, and so what I recommend you do here is look at recent data. So as you can see on the screen here, appreciation rates have been slowing down, coming back down to earth since the pandemic, and are now at 1 or 2%. And that's pretty low. That's below the pace of inflation, and it's well below the national average. So that is something we're going to want to think about. The other thing we're going to look at here with this data from Redfin is inventory. We're going to look at this because inventory is a predictor of short-term appreciation. And what you can see here in Waxahachie is that inventory has not just really skyrocketed since the pandemic, pre-pandemic. It's actually well above pre-pandemic levels. And to me, that suggests prices are going to remain soft in the short run. So for me, even though Texas is growing, I'm not going to put any appreciation above and beyond what my conservative estimate, which is 2%. That is still below the rate of inflation. So I'm being very careful right now because I think 2% is a low estimate. So I'm going to put 2%. That is very conservative, and I feel good about that. And if I'm wrong and appreciation is actually higher than that, that's just gravy. All right, so that's step 2. We've now done property info and purchase, and we're going to move on to loan details. This part of the calculation is pretty easy. As an investor, I'm going to put 25% down, and I'm going to put 7% for my interest rates. That's about what they are right now, but you can always just check with a lender. That's free, and find out what interest rates would be for you and what you qualify for. Points charge is going to be 0, and I'm going to put 30 years for our term, and loan details are done. That part's super easy. So the next big assumption that we need to make and be really clear on during our calculations here is rent. And this is a common place where people get tripped up because it can be hard to figure out rent. But at BiggerPockets, we have this tool called the rent estimator. And so what we're going to do here is just click view rent estimate. And it's going to pull up for us what BiggerPockets, based on a lot of comps, feels the right rent is. And so what you can see here is that for our property, our median rent estimate is $2,650. And you can scroll down and see that this is based on really good comps, right? So you can see that this comp right here is right next to the property. This is from only like 3 weeks ago. It's a very similar sized property. That's 2,500. So that's a good comp. We also see another comp nearby. That's 3,000. And so you can see the range here is 2,650. Now, for me, I am thinking what you have to do as the investor now is sort of think like, okay, this is showing me a range, and this is the median rent of 2,650. Ask yourself, is the property that you're analyzing the median property? Is it about average for the area? If the answer is yes, then yeah, use 2,650. But because in this deal, I'm going to do a renovation. Remember, I'm putting $50,000 into this property. So I actually think that my property is going to rent for higher. I'm not going to go all the way to this end here and say I'm going to get 3,100. That's unrealistic. It might be realistic actually, but it's too optimistic is the key. Like you don't want to say like, oh, I'm going to get the best possible rent. That's not a good policy. I also not going to go like, 80th, 90th percentile. So I'm going to actually stick around 60th, 70th percentile. I'm going to go with 2720, which is about, is a little bit higher than our median, but is not like assuming that I'm going to command the highest rent in the whole neighborhood. So I'm going to go back to the calculator in there and put 2720 in and move on. We do need to put income growth in here. So similar to our property appreciation, we need to make an estimate for what we think rent growth is going to be. Now, you should look at recent data, and I'll show you here. I pulled from Zillow median rent over time, and you can see it's down a little bit from last year in Waxahachie, but it's basically even. Now, rent usually grows, 3 to 5%. But again, because there's some volatility in this particular market, I'm going to put 2% just to be extra conservative. If you're in a market where there's low supply, people are moving like crazy, you can put higher. If you're in a market that's oversupplied, that is seeing rents go down, like Austin, Texas, for example, right now is seeing this, you might want to put flat income growth just to be extra safe. All right, once you've done that, we move on to our last step, which is expenses. So the BiggerPockets calculator is already pulled in from public record data are taxes. Taxes, property taxes in Texas are expensive. As you can see here on just a property that costs $265,000, we're paying almost $7,000 a year in taxes. We're going to see what that does to cash flow, but that's going to hurt. So for insurance, I just Googled this before. It's another way to do it. Just Google it or talk to a broker. A lot of times you can get a quote online for insurance in like under 5 minutes. So our property here, I'm going to put $1,400 for our insurance and then go on to what are known as variable expenses. So this is another area where you really want to be good at estimating. And so repairs and maintenance, this is something you want to put aside money for. I'm going to put 5% here, because I'm putting a lot of money in up front. If I was buying an older house that I'm not going to renovate, I would probably put 10%, maybe even 15%, because a lot of things are going to break. But I'm putting 50 grand in up front to replace a lot of stuff to make the whole place nicer. And because I'm taking on that expense up front, I'm estimating that my repairs are going to be a bit lower. Vacancy, I like to put about 6% most of the time, and capital expenditures, I'm going to put 5%. 5%, again, is similar to repairs and maintenance, but it's for big things like a roof. But we already know that this roof's only 3 years old, probably has at least 20 years left on it. We're going to service the HVAC up front. We've factored that into our expenses there. And so I'm going to put 5% in, which may actually even be a little bit high. But again, I like being conservative, so I'm going to put in 5%. As a long distance real estate investor, I'm going to put in 8% for management fees because I need to pay my property manager. And then I'm going to go on to utilities. Now, because this is a single family home, I actually don't pay utilities. You let the tenants do that because they're the ones using it and you don't need to get involved. There is an HOA here, so BiggerPockets again has pulled this in for you, which is super helpful. It's a very inexpensive HOA. That's crazy. It's like $100 a year. So it's $12 a month, so very light on HOA fees, but that's what we got. And we're done. So we're going to hit finish analysis. Hopefully you guys can see how easy this is. If you remember, we talked about the 2 steps to deal analysis. One is the math, which the calculator is doing for us right now. And the second is the inputs. And hopefully what I've explained to you helps you with those inputs. So what we see here, now that we've analyzed this deal, is that it's a little thin. I personally wouldn't buy this deal as is. It is cash flow positive, so we're seeing $50 a month in cash flow, which is okay. But the cash on cash return here is just 0.5%. So you might abandon this deal right away, but that's not what I would do. Instead, what I would do is see what numbers would have to be accurate or true to make this deal work for you. And I know for newer investors, this concept doesn't always click right away, but let me just explain that deals aren't always found, especially on the MLS. If you just go out and look for them, they're not going to be exactly what you want them to be. You have to cater them and design them in a way that makes sense to you. So as an example, we are assuming in this first round of calculations that we are paying full purchase price, which is $265,000. But let me show you some data here that shows that in this market, we have something that called the sale to list ratio, which is basically, sellers put their properties up for whatever they want. We have the opportunity to negotiate in a lot of cases. And in this market, Waxahachie, actually buyers are on average buying properties for 2 to 3% lower than asking price. So let's just assume that we are going to do something similar. We're going to take this little slider here and we're going to slide this down to, let's say we can get it for $258. Okay. Now our deal looks a little bit better. It's still probably a little thin for me. The cash on cash return is under 1%. And I personally would buy a deal, not at 1%, probably a cash on cash return of 2 to 3% if it was in a really appreciating area. But I looked at some of that data and I think there's some volatility here. And so in this type of market, I personally would be looking for probably a 4 or 5% cash on cash return. So I think some things you could do are maybe even go down to 255. All right, now we're at 1%, but dropping the price even to 252, it's still not getting us there, right? So here are some things that we might want to do. One would be see if the seller will buy down our interest rate. And this is pretty common right now because sellers who need to move their inventory will do this. So let's just say that they buy this interest rate down to 6% for us. Okay, now we're getting a little bit closer, right? Now we're at 2.4%. And guys, I don't know if the seller will accept this, but what I'm showing you is that when you're running your numbers, you can come up with a deal that will work for you and work with your agent then you present it to the seller and they say yes or no. Like, that's up to them. The other thing though I would do though before abandoning this deal or making this offer is talk to a property manager, because remember, this rental income, it basically, my rent is going to be somewhere between $2,500 and $3,000. And I'm on the lower end here at $2,720. And so if I call the property manager and say, hey, look, this is the deal that I am looking at, and I'm going to put 50 grand into it, I'm going to make it look a lot better, then, you know, maybe they say that your rent actually is going to be $2,856. Okay, now we're getting closer, right? We're at 3.6% ROI. That's pretty good. And with our annualized return, because remember, we're doing sort of like a BRRRR strategy, we're doing value add here, we're getting a 13% annualized return. This is a deal I would almost consider. I would actually look more into this, because even though the cash flows, it's fine, it's not amazing, but it's actually decent given the current market conditions. Because I can get that value up to 350, 360 by putting in 50 grand, my total return is really good. And personally, I invest for both cash flow and appreciation. And what I'm seeing here is an annualized return is 17% after 3 years. 5 years, I'm going to make 100 grand if I invest in this deal. So that's really pretty good. So I would think more about this. I would talk to my agent. I would talk to my property manager and see if the seller is willing to work with me on some of the things I would need to make this deal work. If not, that's okay. Remember, everyone, the reason I'm showing you this is because I want you to make conservative estimates during these economic conditions to make sure these deals work for you. Not every deal is going to work. You're going to analyze a lot before you find one that's good. I think usually it takes 20, 30, sometimes even more in-depth, detailed analysis like we've done here before you find a good one. But as you see, if you use a good tool like the calculator here and the rent estimator that I was showing you, and you get good at making good assumptions, you're going to be able to do these deal analyses in 5 or 10 minutes. And so doing 30 of them before finding a good one, it doesn't become that intimidating. So hopefully this has been helpful to all of you. Remember, there's basically just 2 things that you need to do to analyze deals well right now. 1, use a reliable tool, and 2, get good at putting in the right assumptions into those tools based on market conditions. You can find great data on Redfin, Zillow. There's a lot of publicly available data that will help inform your assumptions, and I highly, highly recommend you use that. If you guys want to use the BiggerPockets calculator, the rent estimator, or any of the other tools that come with BiggerPockets Pro, remember, we're giving you 20% off today, so make sure to take advantage of that. Use the code DAVE24, that's DAVE24, when you go to biggerpockets.com/pro, and you'll get all the amazing benefits that help you start, scale, and manage your portfolio. For BiggerPockets, I'm Dave Meyer. Thanks so much for watching. I'll see you soon.